Pre-qualified, pre-approved, and down payment. 3 terms associated with buying a house. If you'd like to learn more about it, stick around. Hey everyone, Roger the Realtor here with Keller Williams Realty. As always, thanks for stopping by my channel again. I'm glad you're here. It's very easy to get lost in all the terminology associated with buying a home, new or pre-owned, and not the least of which is the financing process, which is one of the very first things you need to address when you start your search. Well, today we're going to try to simplify that by going to talk to my good friend and one of the very best mortgage brokers I've ever done business with, Mr. Dennis Gary. Now, even Dennis can't explain the entire process in one short video, and we're not going to bore you to death with that whole thing here today anyway. We're just going to talk to Dennis for a few minutes, get the highlights of some of the most common questions that he hears as a lender and I hear as a realtor practically on a daily basis. Hop in, let's take a ride over and visit with Dennis Gary with Integrity Mortgage. One of the first things, and most often things I get asked is what's the difference in pre-qualified and pre-approved? Because people will show up to look at houses and say, well, I'm one or the other, but they don't really know the difference.
Okay, great question. Pre-qualified would mean that we have run their credit and we've got a basic understanding of what their assets and income is, but we don't have it fully authorized and authenticated. So pre-qual is just kind of a general, yeah, you're probably going to be okay. Pre-approval, or what I call a full credit approval, is when we actually get documents such as pay stubs and W-2s and tax returns and bank statements. And what we can do is we can verify all the income and assets, and then we issue what's called a full credit approval letter. And that helps when you're going to try to buy a house and win the deal if there's multiple offers. So pre-qual is just you're hoping everything's good. Pre-approval or full credit approval means we have verified their income and assets, and all we've got to do is get an appraisal. We're already locked and loaded and good to go.
Do they have to come in to see you in the office to get that?
They do not. We can do everything over the phone, and we can do things through DocuSign, and with password protection we get documents that way.
If I send a first-time buyer to you and say, I want you to call Dennis Gary at Integrity, so when they make that phone call, what's the very first thing you're going to have them do?
Well, we like to visit with them on the telephone. We need 15 to 18 minutes of their time. We want to ask them what their goals are, if they're a veteran, they can do 0 down, or if they want to put 3% down or 5% down or 10% down or whatever. We ask them several upfront questions. What's the purchase price that you're generally looking at to purchase? How much do you want to put down? What is your goals as far as a monthly payment, including your taxes and insurance and so forth? And once we get their goals, and we try to get a loan that will meet all those goals for them. And then we can also get their information on the telephone, such as social security number and data, which is 100% confidential. We get their permission to pull their credit, and within an hour, we can have an approval letter for them.
Okay. Well, I'm glad you said that about pulling credit, because one of the things I hear is when do you do a hard pull, or maybe I'm not saying it correctly, but people want to know, does it affect their credit when they first talk to you?
Great question. No, it does not. You can have your credit pulled 2 or 3 times in a 90-day period because the FICO people know that when you're shopping, you may have your credit pulled 2 or 3 times.
The other thing that I usually hear is how much down payment is it going to take? Because everybody's got a cousin, an uncle, a brother, a neighbor that just bought a house with either 0 down or 20% down, or you have to have 20.
Okay. Like you said, we can get down. We can do conventional loans for as little as 3% down. We again go through that the goals for each client, what they're wanting to do, and we've had some people that want to put 20% down, and then we'll look at their situation and we can say, well, if you put 5% down, have mortgage insurance for a little bit, you can pay off 2 vehicles and maybe save $400 or $500 a month. So we try to also get in situations where we can help them help their money make them money, if that makes sense. So
Sure.
we'll go over different scenarios with them, but the down payments are as little as 3% down.
Well, and you mentioned earlier about MIP, mortgage insurance premium.
Yes, sir.
Can you speak on mortgage insurance?
Absolutely. If you put 20% down, there's no mortgage insurance. If the credit scores are pretty good, then we try to go conventional loans, because the mortgage insurance, if you put less than 20% down, will remain on the loan only until you get 20% equity. At that point in time, they will fall off. On FHA loans, the mortgage insurance tends to stay on there forever. So we like conventional loans a little bit better because the mortgage insurance will go away eventually.
How does credit score play into what types of loans that they qualify for?
Great question again. The higher credit scores get you the better rate on conventional loans. Lower credit scores, we generally, depending on how much a person wants to put down, we'll generally go FHA because we get better rates on FHA with lower credit scores. Of course, the higher the credit score, the better it's going to be for each individual. And what we do too, Roger, is if somebody's kind of in the middle, we'll give them two scenarios, one with a conventional loan situation, one with an FHA, and just compare and see what's best for those people whose credit scores are good but just not great.
Right.
Part of our service includes helping people who may have some credit issues, or there may be things in their credit report they weren't even aware of. And we can address that and help them get that removed and up their credit score and get either better rates or help them get to where they want to go as far as a home purchase if it's a little bit more. We do that all the time.
What about when people say, are there down payment assistance programs? Mm-hmm. Is there such a thing?
What it boils down to is you can get in for zero down, but the rates are going to be about 1.25 higher than normal FHA rates. There's no free lunch.
Right.
So what happens is on these down payment assistance programs, you pay for it through the rate. And what I recommend to my clients is try to get the down payment, don't have the down payment assistance, and you can get a gift from a family member to get that and get a lower rate, because why pay 1.25 points higher to 1.5 points higher on the rate instead of getting a rate of, say right now, 3.5%, why pay 5% for 30 years potentially? And it's not cost effective. So there are down payment assistance programs. I don't like them because the rates are higher and people really in the long run, it's not beneficial to them.
One of the things that I hear a lot is my payment went up, and I start explaining, if you had a fixed interest rate loan, your payment didn't go up. Your principal and interest stayed the same.
Correct.
I mean, the amount stayed the same.
Right.
What went up was your taxes and insurance.
Right.
Am I saying that right?
You are. And something else that just came to mind to me also, when people are buying a brand new home, a lot of lenders don't set up their payments with improved taxes.
If we buy a pre-owned home, if I help someone buy a pre-owned home and you help them finance it, then we know what the taxes were based on last year's taxes, and that's the estimate you go on. But when you go to a neighborhood that's fresh up out of the ground from a production builder, let's say, those taxes could be artificially low based on the land value that was there when the builder bought the property.
Correct.
And then some lenders are not allowing for that in the future, and there comes the boomerang.
Yes. And that's why we set up everybody on improve taxes, or explain to them and work with them on what they need to do to make sure there's no surprises down the road.
Excellent. So between myself, you, and a good title company, we can get them in the property that best suits them, makes them happy. When they get ready to change, we're still here.
Absolutely. We help our clients. We tell our clients, no, you do the same thing. A year from now, 2 years from now, you have any questions on anything, you call me. And I've had clients call me about, well, my payments went up because my escrows went up. Why is that? So we'll research that for them and help them explain those situations.
Excellent. And that's why the name of this company is what?
Integrity Mortgage.
Integrity Mortgage. Dennis, been a pleasure.
Same here, sir. Thank you so much.
Well, there you go. I hope you enjoyed our visit with Dennis. I always learn something when I listen to him talk, and I trust that you did too. If there's more you'd like to hear about the mortgage process, give me a comment down below, and you know where I'll go to get our answers. My team and I will do our very best to vet out any idea you have about real estate, life in Garland, the greater Dallas area. That's what we're here for. We like living here. We think you will too. And if there's anything we can do to help you make that decision, that's why we started this channel. So as always, I'm Roger Phillips with Keller Williams. Thank you for stopping by my channel.